SCHD is a dividend ETF favorite for investors looking for both dividend yield as well as dividend growth. And the great thing about SCHD is it's also a great complement to the tech-heavy S&P 500. However, SCHD has been in a bit of a slump of late, falling more than 6% in the past month and down nearly 10% from its recent 52-week highs. So is it time to dump this dividend ETF, or is it time to double up? We'll talk about this in today's video, but before we do me a huge favor, simply show your appreciation by clicking that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, you can check out their 10 best stocks to buy right now by going to fool.com/Mark, or you can check out the link down in the description below. All right, let's get back to today's topic, talking about SCHD, a dividend ETF favorite. And when people are looking at SCHD, the reason being it's so popular is that it checks a lot of boxes. SCHD can give you growth potential. SCHD can give you higher yield than most high yield ETFs. SCHD can give you solid dividend growth. In fact, faster dividend growth than most dividend growth focused ETFs. Looking here, you can see that SCHD offers a juicy dividend yield of 3.6% to go along with a solid 5-year dividend growth rate of 11.6%. Let's compare that yield to two popular high-yield dividend ETFs, HDV as well as VYM. HDV has a dividend yield of 3.65%, so pretty much in par with SCHD, and VYM has a dividend yield of just 2.72%. Now let's compare the SCHD dividend growth rate to the two popular dividend growth focused ETFs that are VIG and DGRO. VIG has a 5-year dividend growth rate of 9.6%. DGRO, a 5-year dividend growth rate of 8.3%. Both of them lagging the 11.6% that SCHD has. All of the talk that I've been hearing about of late, a lot of messages I've been getting is about SCHD and the sell-off. If 1 month sell-off is going to have you running for the hills, then you shouldn't probably be investing in the first place. If anything, you should be running back to the stock. Stocks that you like, stocks that are high quality, trading at a lower valuation, that's when we want to buy. It's amazing to me for new investors when a stock is up over 100, 150% and they have no issue buying it. But if that stock falls just 15% in a short period of time, we no longer like that stock. We're no longer looking to buy it. That's baffling. And if you recall, the great Warren Buffett once said that we want to be fearful when others are greedy and greedy when others are fearful. Over the years, SCHD has proven to be a great complement to tech-heavy portfolios. Now what is becoming an S&P 500 ETF, which is very top-heavy with tech titans. If you're going to sit here and compare the likes of SCHD to top growth-focused ETFs, that's just not a fair fight. That's not the intention. That's not why SCHD was created. SCHD was created to give you a well-balanced portfolio that will give you some growth potential, will give you a solid dividend yield, and will give you strong dividend growth. However, prior to this AI boom that we've seen over the past few years, did you know that SCHD actually outperformed the S&P 500 over a 10-plus year period? Since SCHD's inception back in 2011 through the end of 2022, prior to this big AI boom, which anyone that says this is the new norm is just outright lying to you, but over that period, SCHD returned over 300%, compared to the S&P 500 returning 274%. Now, in the past 2 years, the story is way different. But 17% returns from SCHD is not terrible, but it does badly lag the S&P 500, which is up nearly 60%, which again is not normal. So is now the time to run away from SCHD, or is it time to double up? Well, first you got to ask yourself a few questions. Are you looking for yield? Are you looking for dividend growth? Are you looking to balance out your portfolio on what may be overextension into technology or the S&P 500? If the answer is yes, SCHD is going to be one of the best options out there. Let me explain a little. Let's first take a look here at the sector breakdown for SCHD, where you see the top sectors include financials, healthcare, consumer staples, industrials, and energy. Nowhere in the top 5 do you see technology or communication services, which are the 2 largest sectors within the S&P 500. Nope, if you go further down the list, you will see technology accounts for just 10% and communication services less than 5%. Now let's take a look at the top 10 holdings, which recalibrate every quarter and are fully repicked every March. So just a few months away until we see some major changes likely coming to SCHD. The top 10 holdings include Pfizer, BlackRock, AbbVie, Cisco Systems, Coca-Cola, Bristol-Myers Squibb, Texas Instruments, PepsiCo, Lockheed Martin, and Amgen. In total, SCHD has 103 holdings, and the top 10 make up more than 40%. So now what we're going to do is a little exercise where we're going to take a look at the top 10 holdings and their upside. I'm going to show you the average price target for analysts over the next 12 months and the implied upside where that price target is to give us a better idea of where could SCHD be headed. After all, these top 10 holdings make up roughly 40% of the ETF. Let's begin with Pfizer, which is not a stock I'm all that crazy about, but the average 12-month price target for Pfizer is over $31. The potential upside, 18.5%. This stock hasn't performed all that well in the past month, hence the downturn, the pressure that we've seen on SCHD. Next is BlackRock with an average 12-month price target of $1,145, which implies roughly 12% upside from current levels. Next is a favorite of mine and one of my longest held positions in AbbVie, stock ticker ABBV. Analysts have an average 12-month price target a little over $200, implying roughly 17% upside over the next 12 months. Next, we move to Cisco Systems, where analysts have an average 12-month price target of $63.50, implying roughly 7% upside from current levels. Now we move on to Coca-Cola, stock ticker KO, where the average 12-month price target's at $74, implying roughly 20% upside from current levels. Now we move on to Bristol-Myers Squibb, where analysts have an average 12-month price target of $61, giving it potential upside of 8%. Next on the list, Texas Instruments, where analysts have an average 12-month price target of $217, implying 15% upside from current levels. Next on the list, PepsiCo, stock ticker PEP, where analysts have an average 12-month price target of $185 per share, implying 22% upside from current levels. Now we move on to Lockheed Martin, another favorite of mine, where analysts have an average 12-month price target of $617, giving it nearly 30% upside from current levels. The defense sector is one that has had heavy selling pressure, hence, again, why SCHD is down. One of its largest components, or a multitude of its largest components, have seen selling pressures of late. And the last one is Amgen, stock ticker AMGN, where analysts have an average 12-month price target of $346, giving it potential upside of nearly 35%. So if we were to take those top 10 stocks right there, and we look at the potential upside for each of them based on the average price target of all analysts that cover each of these potential companies, that would give us 18% upside for these groups of stocks. And again, that's just share price appreciation. That doesn't take into account dividend yield and the dividend growth that comes along with each of them. This ETF has a formula that has been proven to work for more than a decade now. Don't just chase growth to chase growth. Look for high quality companies that may be undervalued, which a lot of those within the top 10 of SCHD, that is the case right now. But when it comes to building generational wealth, balance is key. Diversification is key. Buying low and selling high. That's the way to do it. So with that being said, let me know your thoughts on SCHD down in the comments. Are you running or are you looking to double up your position? Thanks again for joining today's video. And if you haven't done so, make sure you smash that like button. And also, Become a part of our Stock Investors Edge community, where you can check out our free Discord. You can also upgrade your membership and see my entire portfolio, get our research reports, and so much more over there in that Discord community. So you can check out a link down in the description below. And with that being said, we'll see you in the next one. Take care.